So far this month, which is a non-delivery month in silver, just shy of 8,000 contracts have stood for delivery already at 5,000 ounces apiece. So do the math. I mean, it's not a delivery month, but it's still an awful lot of silver.
Yeah, it's a lot.
And yes, it is harder because if in a game that is just cash settled amongst coordinated players across the globe, it's easy to suppress the price. But when all of a sudden you are being challenged not only by central banks and sovereign wealth funds across the globe, but now a large, what appears to be entity here in the United States who are literally bringing in billions of dollars a month in silver onto COMEX, something's different.
Over the past few weeks, we've witnessed one of the most curious and misunderstood developments in the gold and silver markets this year. Prices, which had rallied for 9 straight weeks and pushed far above key technical levels, suddenly tumbled in what appeared to be a textbook correction. But when we look closer at the timing, the trading patterns, and the players involved, it becomes clear that this wasn't simply a natural market pullback. According to Andy Schectman, the precision and odd timing of these sell orders point to deliberate price suppression, an engineered move designed to allow institutional players to quietly accumulate massive physical positions before the next leg up. Silver, in particular, has shown unusual strength beneath the surface. Despite the price drop, delivery volumes on the COMEX have surged. Over 8,000 contracts standing for delivery in what isn't even a scheduled delivery month. That's nearly 40 million ounces of silver physically demanded in a market that has relied heavily on paper leverage to control prices. These numbers don't align with panic selling or waning demand. They indicate a silent transfer of metal from weak hands to strong ones. And when that physical supply begins to run thin, paper tactics lose their grip. This activity underscores a larger divergence between the paper and physical markets, a theme Schectman has long warned about. When prices are driven lower in thinly traded hours by algorithmic sell orders, but physical offtake accelerates at the same time, it suggests desperation from the short side. It's a signal that supply constraints are tightening faster than official narratives admit. Meanwhile, global central banks, sovereign wealth funds, and now large U.S. entities are collectively taking delivery, showing that the smartest money in the world isn't fooled by temporary price dips. They're treating these pullbacks as opportunities, not warnings. The broader backdrop amplifies this trend. With debt ballooning, rates plateauing, and geopolitical risk on every front, the world's financial architecture is straining under its own contradictions. The next few clips will feature Andy Schectman breaking down not only the mechanics of the recent silver dump, but also the underlying motivations of those driving it. He also ties these events to deeper economic realities in the United States, from fiscal recklessness to the quiet shift toward a post-dollar order. Before we dive in, make sure you stay through to the end. Andy's analysis reveals why these price corrections are nothing more than brief intermissions in a much larger monetary reset, and why those paying attention now are positioning themselves ahead of one of the greatest wealth transfers in modern history.
Well, I think it's when you look at it from the mainstream perspective, yes, much of what they said was valid. It had gone up, really unencumbered for 9 straight weeks. It was overbought. All of that's valid. All of that's true. It had busted through well in excess of moving averages, the 50, the 200. All that's true. It was ripe for a correction and a flush and a pullback, and all of that is true. And if it had been said that way, of course, they always throw in, is this the top, the 2011-1980 top, where it starts to head down and maybe, this is it, maybe look for other assets, Bitcoin or whatever the hell you want to talk about it. If they would have just told the other half of the story, I would have been more inclined to acquiesce to some of their validation or to some of the things that are valid. I think by not telling the whole story, it invalidates much of what they say. The initial snowball that was pushed down the hill was in the middle of the evening after all of the markets had closed and the New York traders were in bed, and it was sold in the access market, it being gold and silver, billions of dollars worth, in the middle of the evening when there's no liquidity, when the markets aren't there to catch the bids, and instead the driving down of the price, dumping it onto the market at strange hours. When it started, it was in the middle of the night. I don't remember exactly what time. And then the next day they did it like 8 or 9 o'clock at night, when in between New York and Asia. Again, New York's closed, Asia hadn't opened yet. You see a price that's getting clobbered, because all that does is hit the sell stops that are embedded in algorithmic programs along the way, and they drive the price down. In other words, this was done as a drive-by shooting for an effect. There would not be a trader on the planet with a third of a brain cell that would dump all of this at a time outside of New York trading, where that's where the price is set. That's where the bids would be. They would do it slowly and judiciously over time, even a matter of days, that amount, slowly, without alerting or waking everyone up to a dumping of metal. And they would catch all of the demand for 9 straight weeks that have been growing up. They would have got a much better settlement. In fact, they guaranteed themselves the absolute worst settlement. And so the selling triggering stops made the market collapse. Now, what they also didn't talk about, and let's just stop right there for a moment. If they would have said all of those things, market's overbought, gone up for 9 straight weeks, the technicals said this is ripe for a correction, for a flush, for a pullback, whatever validation they want to attach to it, it's invalidated by not saying, by the way, some idiot dumped it in the middle of the night when there was no liquidity in the market and there were no traders, and this is done in the access market. Nobody would do that. They conveniently leave that part out. The other part that they left out was the second day, when it was done in between New York and Asia. Again, equally a stupid time to do it. Within just a few minutes, the silver price shot right back up. Well, how the hell did that happen? Well, if you look at Michael Lynch, and he does an amazing job at analyzing the COMEX movements, he says that it was Bank of America and Morgan Stanley that came in and did the purchasing. It was European banks that did the selling, and it's commercial banks, and it was Morgan Stanley that came in and did the buying. Well, why is that valid? Well, the chief investment officer of Morgan Stanley recently came out and said the 60-40 rule of investing that Wall Street's used for, 50 plus years was invalidated now by
60-20-20.
Yes. In other words, sell half your bonds and put 20% into gold. And then that's Morgan Stanley. And then Michael Hartnett, the chief head analyst for Bank of America, says, no, 25, 25, 25, 25. 25 stock, 25 bond, 25 short-term treasuries, 25 gold. And I mean, in my whole career, I've been 35 years, they've never said that at all, ever. Yeah. Maybe 5% they would say. So the two American banks that are saying 20 to 25% allocation come in and do the buying, according to Michael Lynch. And he's got a great Substack. People should check it out. So when we talk about this, the fundamentals are fugazi. The fundamentals are strong as hell. The LBMA is being bled down. I did an interview with Alistair McLeod this morning, and Alistair's like, yeah, I see this morning that the slight backwardation is reappearing between London and the US again. So all the metal that got shipped from Shanghai at exorbitant lease rates and whatever 20 or 30 million ounces that got shipped from COMEX over there to quell the problem. Well, what good did that do? There's still deliveries next month and the month after and the month after. And so the physical demand is overwhelming the paper price, and it's desperation when you come in the middle of the night and dump at a time that no one would do it. It was specifically done to cover shorts and for effect, and for the media to jump on and tell half the story without saying, by the way, some idiot dumped it when no one else ever would, to maximize the worst possible settlement they could ever get. And so that to me invalidates so much of what would otherwise be valid statements. And I think it goes to show where silver is ultimately going. When the U.S. government has proposed and written into draft, and it will be accepted, that silver will become a critical mineral in this country, things are changing. And I think what we saw was a desperate attempt by some really caught commercial banks that are massively short, and the rising price, coupled with a government shutdown and trade meetings with Xi and all sorts of stuff going on. The last thing, and interest rates going to be lowered again, The last thing they wanted is for metal to get way out of control, and this is their way to stop it, but I would argue only temporarily. The exploitation of the delivery option in London and the US is something that was rarely exploited, and now it's being exploited not only by all of the BRICS nations and Russia and China and India and Saudi Arabia and all of the countries that are standing for delivery on all of the world's commodities. But there's someone got to President Trump, in my opinion, and said, if we don't do this, we're dead. We're dead because they're draining the shelves across the globe. And so they phrase it as tariffs and they start bringing it back. It's not tariffs, it's reshoring. All the gold and silver, billions and billions and billions and billions and billions of dollars worth of metal so far this month, which is a non-delivery month in silver, just shy of 8,000 contracts have stood for delivery already at 5,000 ounces apiece. So do the math. I mean, it's not a delivery month, but it's still an awful lot of silver.
It's easy to call a 9-week rally overbought or to dismiss a sudden drop as a healthy correction, but Schectman's argument is far more nuanced. The evidence suggests that this flush was strategically executed during the most illiquid trading windows between US and Asian market sessions to trigger cascading sell stops and give the illusion of market weakness. The goal, however, wasn't to exit the market, but to shake out speculators and create the lowest possible entry points for large institutional buyers. As he points out, within hours of these sharp declines, American banks, such as Morgan Stanley and Bank of America, stepped in as major buyers, while European commercial banks were on the selling side. This kind of activity doesn't signify panic, it signifies preparation. Schectman's perspective reframes the narrative. Rather than being a sign of exhaustion, the pullback was a calculated move to rebalance the market in favor of physical accumulation. The fundamentals remain unshaken. Record central bank purchases, declining London bullion inventories, and re-emerging backwardation between London and New York all confirm an underlying shortage of real metal. In this environment, the paper market's influence can only last so long before the weight of physical demand forces a repricing. And that, Schectman argues, is exactly what's beginning to unfold. As Andy transitions to his broader economic commentary, his analysis of the U.S. fiscal landscape reinforces why the move into hard assets isn't a fringe strategy, it's a necessity. The U.S. has crossed $38 trillion in debt, with interest payments now the largest line item in the federal budget. In just over 2 months, another $1 trillion was added to that total. Layer that on top of $150 trillion in unfunded liabilities, declining literacy and education levels, and a shrinking industrial base, and the picture is one of systemic vulnerability. Schectman believes the political and monetary leadership knows this, and that the quiet policy direction, under the guise of tariffs and reshoring, is actually a strategic attempt to re-anchor the economy by devaluing the dollar and reviving manufacturing through a partial gold linkage. What makes this particularly striking is how it connects with real-world monetary behavior. The same U.S. banks now accumulating metal are guided by internal policy shifts that recommend 20 to 25% gold allocation, something unheard of in mainstream finance for decades. Add in stablecoin legislation that incentivizes treasury-backed digital instruments and creates synthetic demand for U.S. debt, and you begin to see how the financial system is slowly being rewired. Gold will play a pivotal role in that transition, not as an archaic relic, but as a stabilizing benchmark for restructured sovereign balance sheets.
We need to do something quickly. You mentioned $38 trillion in debt and $1 trillion in interest payments, which is the number one line item. We added $1 trillion to the debt in 71 days recently. It's accelerating.
Crazy.
Our fiscal irresponsibility is ridiculous. 60% of America can't read past the 6th grade. 60% of America has no college education. Most people in the country can't write out a check for $5,000 for an emergency.
Wow.
We're broke, we're insolvent, and the 38 trillion doesn't take into account the over 100 trillion in unfunded, 150 trillion in unfunded liabilities, Medicare and Medicaid, and Social Security and government military pensions. And I don't know, there's divisiveness in politics. There's, after the last 4 years of policy that was too stupid to be stupid, we've now entered a period of time where I think it's all about an acceleration in a new system that's coming. So I'm concerned that we have hard times ahead of us. And I think what President Trump is trying to do, if there's any nobility in it, is to massively debase the dollar, to devalue it, to ultimately bring back manufacturing and to relinquish, according to Triffin's dilemma, relinquish the reserve standard. If we are the reserve currency, we will never have a manufacturing base. We will always run trade imbalances. I believe they want to get rid of the world reserve currency. They want to bring back manufacturing. And if Judy Shelton is right, and they peg gold to the back end of the Treasury market next July, you can bring back with a 20, 30, and 50-year Treasury redeemable in gold with zero coupon, no interest in 20 or 30 and 50 years. You can bring back manufacturing immediately with no upfront borrowing costs. And with the passage of the Stablecoin Act, the Genius Act, you look into it and you see that every time money moves, stablecoins will be created. And the interest, because they're backed by U.S. Treasuries, the interest that is generated is not transferable. Tether, as an example, USA Tether, by the way, their CEO is Bo Hines, the guy that was Trump's crypto advisor until August. He's now backing the CEO of USA Tether, which is already stablecoin Genius Act compliant. They will back everything with treasuries, which creates synthetic demand for the treasury, pushes rates down, but they will take the excess, the interest between the stablecoin and the treasury, and they'll buy gold. And I think they'll buy Bitcoin, and they'll buy gold to make it go much higher. They already have over $8 billion worth. They were just at the Beaver Creek Mining Summit. They're going to continue to buy gold to devalue the dollar and to ultimately peg the back end of the treasury market to bring back manufacturing, because we need to. Our children and our grandchildren are dead otherwise with illiteracy and uneducated masses and a massive spread between the haves and the have-nots and no manufacturing base and massively indebted. We need to do this no matter what. And I think they will do that through devaluing the dollar massively by letting gold go higher. I think they'll let Bitcoin go higher and use it to pay off the debt. This isn't conspiracy. Read the executive order that next year they're talking about revaluing gold as part of the Bitcoin fund that Senator Lummis from Wyoming has been advocating for. And if they do revalue it, it devalues the dollar. It's not about revaluing gold. It's about devaluing the dollar to a much lower level so we can sell our products to the world. You have to bring back manufacturing. How do you do that? You peg gold to the back end of the bond market and you end up having zero upfront borrowing costs. There's like in the Shawshank Redemption, there's 2 miles of shit that we have to crawl through to get to the other side, like Andy Dufresne did. And that's what happens with the irresponsible fiscal policy that we've had and the brain dead monetary policy we've had for all these years. To get to the other side, we need to produce things again. We can't be reliant on pharmaceuticals from aspirin to penicillin and everything in between from the Chinese, or aircraft components or military components. We need to be the engine of growth and manufacturing again for a population that, with this limited advanced education, 60% with no college degree, and AI will take 50% of entry-level jobs in the next 3 to 5 years, they say, well, we have to do this. So what am I concerned about? I'm concerned about tough times. I'm concerned about inflation and half-empty shelves that until we are able to get our fiscal house in order and start manufacturing again. I think that, unfortunately, that there will be a couple of years of difficult times, but I think there is reason for optimism if we are able to pull this off. At this point, what choice do we have? We can inflate, we can default, or we can try and grow our way out of the problem. And the only way you grow your way out ever is to bring back manufacturing and to give up on being the reserve currency. You look at all the BRICS nations, they're all talking about trading their local currencies and settling imbalances in gold. You don't see a common currency. You don't see a replacement for the dollar. Everyone used their currency, and gold is finding a common denominator that is trust within the system, whether it be in the Southern Hemisphere or up here in the United States. But something needs to change, and I'm concerned that if it doesn't, things are only going to accelerate in terms of our indebtedness and the effects that ultimately that will have on the reserve currency. Because at some point, a currency that's based on trust that has lost a good deal of trust in weaponizing the treasury market, in sanctions, in tariffs that are actually sanctions that are masquerading as tariffs, and fiscal and monetary irresponsibility, the rubber meets the road at some point. So concerned that tough times ahead. And the only way that you get out of this alive is to have assets. That is how you win. And the biggest, most well-informed money in the world know this. And that's why we're seeing billions and billions and billions and billions of dollars every month come into COMEX. So you know what? Get your own financial house in order and start accumulating assets. You save in dollars, you're going to go broke. One last point to that. You see the dollar index down. The dollar's down 7 or 8% this year against the dollar index. It was down 11. It's rallied a little bit, but it's down almost 70% in silver, even with this pullback, 65. So 60. So the point is, it's masked. The devaluation of the dollar is masked at looking at a basket of all the other brain dead crap currencies measured against something like gold or silver, and you see the real devaluation of the dollar. And this is a trend that will only accelerate.
The implications for investors are immense. If the U.S. truly moves toward a partial gold-backed bond system, where long-term treasuries are redeemable in gold, it would fundamentally alter capital flows worldwide. A stronger domestic manufacturing base would emerge from a weaker dollar, while physical metals would see explosive revaluation as confidence in fiat erodes. The artificial strength of the dollar index, measured only against other weak currencies, hides the deeper reality. The dollar has already lost over 60% of its purchasing power against silver this year alone. That's the true metric of devaluation, and it's one that institutions understand intimately. Meanwhile, AI automation, social polarization, and the widening wealth divide are accelerating the urgency to rebuild a real economy. But as Schectman notes, such transformation won't come without turbulence. Inflationary aftershocks, supply shortages, and volatile markets are inevitable as the system resets. In that context, holding real assets, gold, silver, and other tangible stores of value, isn't about speculation, it's about survival through transition. Every cycle of debt, devaluation, and restructuring throughout history has rewarded those who preserved purchasing power in scarce, real assets. This time will be no different. As billions of dollars continue flowing into the COMEX for physical delivery each month, the writing on the wall is unmistakable. The world's most informed capital is preparing for a monetary realignment. Thank you for watching. If you found this analysis useful, please like, share, and subscribe to stay informed as we continue covering the forces reshaping the global monetary system and the pivotal role that gold and silver will play in it.